Hello, and welcome to the Weekly Watch podcast series. I'm John Briggs, Global Head of Desk Strategy. This series helps you cut through the noise of global financial markets with a quick take on the upcoming trends to watch. It's been quite a week for markets as risk assets have struggled with shortages that are driving up the prices of many things. Sometimes it feels like just about everything. And shortages is something that we've gone over quite a bit the last few weeks, but certainly energy shortages and concerns around them are reaching new highs, to which anyone in Europe and the UK can certainly attest to, but also China, which we'll get to in a minute. The rise in energy prices, driven by shortages and supply issues more broadly, has brought around the issue of stagflation to local highs as well. It's something we've started talking about a couple weeks ago, but continues to get increasing notoriety, at least among financial media. Now, I'll repeat, I am not in the stagflation camp. If we take the assumption that we all know, which is inflation's above target and is running high, and given the supply situation may stay with us for some time, it's not the inflation part that is the issue to me, but the stag part. It comes down if you believe that the slowing of the rate of growth represents stagflation, or if, yes, we're slowing, but growth is still strong, so the level of growth is high enough not to worry about recent slowing. So I'll admit, yes, the rate of growth is slowing. We've actually revised U.S. growth, for example, lower to 4.8% for 2021 and 2.5% for 2022. But to me, that's not stagnation with inflation. That's a slowing of growth back to more normal rates, albeit slower than we expected earlier in the summer. So I recognize the growth slowing, but it was unsustainable at prior rates anyway. So this is just not expected, but actually more reasonable and heading towards more sustainable trajectories. So stagflation for me requires a lack of growth in general, which is not what we have. We just have a slowing of the rate of growth. So all that said, there are risks. Supply issues keep prices of all kinds high, not just energy, but goods and potentially services. Then the rate of inflation can turn out to be a tax on consumption. And that can lead to more of a stagflationary environment as that tax on consumption weighs on consumer spending power and growth slows. So it is here that I bring in Peiqian Liu, our China chief economist. And I bring in Peiqian because if we look past the energy story on its own and what's going on in Europe, we still have the issue of goods shortages from China and Asia more generally, which is an ongoing issue and actually could be a more extended one in time, even if some of the near-term energy issues get worked out. So with that set up, Peiqian, what's your take on a lot of the shortages emanating from the region? Are they likely to persist?
Thanks for the question, John. While most of the factors look transitory, we do have a few more factors we think that might persist slightly longer than our expectations, and I'll go through them one by one. First, the reason for the shortages is perhaps COVID-related. Growth has been uneven across the region from the recovery of COVID. Broadly speaking, manufacturing hubs came back or recovered earlier than resource exporters, which resulted in a shortage of raw materials. And that's already reflected in PPI inflation across the region, especially raw material prices, and especially in China. And secondly, growth has also been uneven within each economy. For example, in China, supply side recovery was much faster than consumption recovery. But on the other hand, in most DM countries, we saw faster recovery of consumption compared to production. So that has resulted very strong demand for goods movements from the manufacturing hubs in the East to consumers in the West, adds more strains to transportation and supply chain shortages and pushing up the costs. And thirdly, the semiconductor shortage is especially acute at this moment. But we think that semiconductor typically follows a 3-year cycle, and that has been interacting with a relatively more inelastic supply. So to dial back a little bit, this current semiconductor cycle began in 2019, just before the pandemic. So the booming chips demand in the rising cycle has resonated with explosive demand for work from home needs. And that's pushing up the aggregate demand for chips. But on the supply side, the supply is relatively inelastic as it takes a few quarters for foundries to push up or ramp up production capacity. So the good news here is that industry leaders in Taiwan and Korea has both increased their investments in production capacity. But the bad news is perhaps it only takes a few quarters for those to put into operation. And our forecast based on the industry leaders' projection is that this excess production capacity will only be in operation in 2023. And lastly, more specifically in China, the latest electricity shortage is what I think fundamentally partly policy driven as well. So in China, the policymakers have set a target to reduce energy consumption by 3% this year in order to march towards its long-term goals of achieving carbon neutrality by 2030. If we look back into the first half of this year again, we had an outperformance in the industrial sector and the export sector, which has pushed up the electricity consumption to double-digit growth. So the local government then has to step in to ration the electricity usage in the second half of this year. From the supply side then, rising coal prices and policy restraints on air pollution ahead of Winter Olympics in 2022 also discourage the producers from producing more electricity. So these factors, we think it's going to persist into the year end, and we see more downside pressures for Q3 and Q4 growth, especially on the supply side in China.
All right, some of these things are going to last for a while. So you mentioned something about policy there, which I want to pick it up on next. So, but a slightly different way. I mean, risk assets have also been pressured as some of the ongoing regulatory changes and policies in China on tech and other sectors have started to weigh beyond assets just within China. We've spoken, you and I, before about common prosperity. So update us on your thinking about this and some of the risks going forward.
Yeah, so I think the electricity shortage and the regulatory crackdown, as well as the property sector slowdown broadly, to me are all symptoms of what I think is a clash between long-term and short-term priorities. We've mentioned common prosperity in our last chat, and I think for now, Chinese policymakers are making use of the window of opportunity in their view, where they don't really have to support growth, and they have to prioritize long-term policies. So overall, it's a balancing act between long-term gain and short-term pains. In the short term, we probably don't have much issue achieving the 6% annual growth target. In fact, with our bearish outlook for Q3 and Q4, we're still looking at around 8% growth this year. So it makes sense for the policymakers to shift their priority a little bit to the long-term gains, whereby they probably have to compromise with short-term slowdowns. So that's why we're looking for a slightly slower growth in Q3 and Q4, just shy of 5%, and that they will focus much more on the long-term priorities, as we mentioned in our last chat.
Yeah, so just quickly on that. So how do you see long-term growth rates settling in for China? So we have a little bit of a slowdown in Q3 and Q4, but what about, let's just say next year, where do you see growth next year?
Yeah, so after these 2 quarters of volatility, I would say, I expect the policymakers to return to cyclical growth priorities in early next year. A few reasons behind that. I see the turn of credit impulse or credit cycle by end of this year, with a few policy normalization process being turning. And I do see the turning points in policy making in Q1 next year as well, after the National People's Congress. So turning into next year, we're probably looking at China's growth returning to its long-term potential growth of around 5 to 5.5%. So that's why we put in our forecast just in the middle of that at 5.3 for 2022.
Great. Thanks a lot, Peiqian. It was really helpful. Thanks for giving us your insight from the region. So I have to say, for stepping back to some of the more near-term issues for the rest of us, the podcast that I'm recording now is being recorded before the U.S. employment report, which we expect will be strong enough to allow the Fed to start the tapering process in November. So famous last words. I hope that's what it turns out to be. But that's also, the Fed and also the Bank of England, those hawkish weeks, their central banks a couple of weeks ago, I think also continues to be one of the weights that are on risk assets. There's a lot facing risk assets in this time, which is something we expected. We thought we'd have a lot more volatility, although come out the other side of it okay. But that might take another month or two, probably till middle of November, at least probably the end of November. But as it stands for next week, we'll be watching the inflation data in Europe and the US, as well as industrial production in many nations. On the political front, we still have ongoing issues with the US fiscal stimulus package and the debt ceiling. So even though we get through a busy week this week with a lot going on, with an issue of shortages and risk assets having a tough week. There's going to be lots to watch still next week. So good luck and have a good one, everyone. Thanks for listening. I hope you have enjoyed this episode of the Weekly Watch. Please subscribe to our channel to get future episodes. We also encourage you to explore more of our content on our website and other social media channels.